This is very noteworthy that Blackstone's private equity returns are beginning to trail the S&P 500 because in the alternative space, typically you're looking at 2% asset under management fee, 20% of the profits. Why would you be forking out all that cash if you're going to underperform? This is a new development. All right, here's some math for you. From 1986 to 2022, private equity performance is about 14.28% compound annual growth rate. So during that time period, if you started with $1,000,000 in the S&P 500, you would have made about 26.3 million net of fees, taxes, whatever. Private equity at 14.28%, you'd have about $139 million. So if this trend is going to change, it's certainly something to keep your eye on. Now let's look at what it looks like here. So this is in blue, private equity buyouts, in yellow, Russell 2000 growth, 12-month trailing enterprise value to sales. Okay, so this doesn't go all the way back to 1986, but you can see from 1995, you could get a company of more or less equal value for half the price of what was an IPO or some type of stock or company that was trading in the public markets. So there was real incentive to get these deals done in the private equity space. Started to trend upwards a little bit here, a little bit here, a little bit here, and then suddenly, boom, 2020 to 2024, the past 4 years or so, now that valuation advantage is gone. And why are you going to pay more for these funds, these secondary funds, or these Blackstone types that are out there? If they're going to underperform, why fork out the cash? Get into the public markets. And maybe that's why you're seeing all this capital rotating into the Mag 7 and these mega cap growth stocks that we're seeing leading the way for the past couple of years here in the public markets. And now if we look over here on the other side, okay, so these private equity backed exits. So we're looking at the owner operator types or these companies deciding to sell to a private equity fund or some type of asset management firm. You can see 2019, 2020 pretty steady, 2021, this was a great year. Markets did well across the board. So, the stimulus coming in after COVID, and we've just really trailed off. And, 2022, 2023, you might have said, okay, so this is, maybe this is just a reversion to the mean here. But in 2024 so far, the pace is pretty slow. So we're going to see if that picks back up. But what I think is happening here is now that the valuation advantage is gone and you're starting to get really good returns in public markets again, it's kind of just a situation where the cat's out of the bag, or whatever the phrase is, monkey's out of the bottle, whatever it is. When that happens, when capital begins to rotate, people are advantageous or looking for advantages in the markets, and they're going to put their capital where they can get the highest return, maximum reward for minimum risk, all the standard cliches. What I do think, though, moving forward is something we say in commodity markets when we have inflationary pressures, is we would say the cure for high prices is high prices. What does that mean? Well, growth is going to decelerate. You get some economic weakness when prices are too high, and then it basically solves itself. The vice versa of that, the cure for low prices is low prices. We see this in natural gas all the time. Spot price of natural gas goes down. These oil and gas companies that produce and manufacture, they turn their rigs off, and then the price comes back up because suddenly demand outpaces supply. So let's see if in the world of the alternatives that the cure for this is the problem itself. Let's see. And then let's take a look at some of the other stuff that's going on out there. The private credit markets, I think the reason that I'm highlighting this one is because you got China real estate and Japanese yen in the bottom there. When you see this stuff, you gotta take it, you gotta read between the lines here. So shadow banking viewed as the most likely source for a credit event, meaning some type of liquidity event, some type of crisis, like Lehman Brothers in 0809. When you get a credit event, it causes a jam in the system, margin calls, forced selling, you get these dramatic repriced assets, 10, 20% limit down in the stock market, and everyone's panicking. So the fact that they're trying to pin this on private credit in advance leads me to believe that they might want to get their rules and regulatory framework to cut down on these things, which is, I don't want to use the C word and call it a communist style maneuver. But here's the reality. Private credit, we can We can find a way to go around, to circumvent the bureaucratic nonsense with the credit and lending process. There's always going to be a use case for it. There's always going to be a need for it. I don't know if extra rules and regulations are going to be a good thing, or if it's sleight of hand to try and become the lender of last resort and never allow these private credit deals to even take place. I don't see how you could stop that, but I don't think their goal is going to be to stop it. What they'll want to do is decrease the credit spread to where you're forced, or not forced, but it's more attractive to take a risk-free government debt obligation. Because the spread right now, it's like government debt you can get for 5%, but in private credit, for some lender who wants to get something done quick, it might be like 10 or 12%. And we've seen it as high as triple the risk-free rate. So, when you run the numbers and you can get double or triple what you're getting risk-free, and you do your own underwriting and you feel comfortable, you're going to take the double or triple. Why wouldn't you? So I think, keep your eyes peeled for something like this. If they try and pin economic problems on private credit, be skeptical, but, let's see what comes with it. But then another one, that's not what we wanted to look at. Another one to look at is, as far as items that are never going to go away, hedge funds are always going to be out there. I was looking at Pershing Square here. That's Bill Ackman. Maybe he would perform better if he wasn't tweeting all the time. But hedge funds, except for the ones that underperform, collecting 2% and 20, I wouldn't be giving 2 and 20 to a lot of these guys. But at the top here, some of these hedge funds still do a fantastic job as we move into volatile, uncertain times with weird stuff going on, politics, inflation, these stretched valuations, China risk, Russia risk, Middle East. We could get some volatility that will tend to create opportunity for some long short funds to really outperform. So hedge funds, they're not going to be going anywhere. Private equity, obviously not going anywhere. Private credit, not going anywhere. Bitcoin, cryptocurrency, commodities, fine arts, whiskey. There's other stuff out there that balances out your portfolio to get you to where you have, let's say, 10 or 12 non-correlated assets, and you're always going to have a bull market somewhere in your portfolio. That's the goal. Privates and alternatives can help you get there, but just be careful. We're in a little bit of a strange dynamic here where public market returns for fewer fees are outperforming. So, make sure you're working with your financial advisor and coming up with a good wealth management strategy. And if it's with us, hey, by all means, let us help you out there. All right, take care, folks.